Stephen, let's start with you and the broader impact of what you heard yesterday on financials.
Yeah, good morning, Frank. I think for the near term, this puts incremental pressure on financials, on banks in particular. I think most of the companies we've been speaking to were hoping for more commentary around a pause as opposed to this, what sounds largely like a skip here, at least into July. So what we've heard over the last week is that most banks feel NII and NIM estimates from the street are a little too high, that deposit pressure has continued to increase in the past few weeks. While deposit balances have stabilized, that pressure on the cost has continued to escalate. So I think if this is truly a skip, that increases that dynamic and could put incremental pressure even on estimates for the sector into the back half of the year, even before we get to the potential for a recession.
So you say there's potential for pressure, but when I'm looking at the KRE, it's actually month to date, at least, it's doubled the market so far. So is that just as simply bouncing off the lows, or have investors decided to rethink how they see the regional banking sector?
I definitely think it's been a recovery trade bouncing off those lows. I mean, we're still waiting for the generalist investors to come back into the group and kind of see what that catalyst is. The hardest part is trying to disprove the negative around potential credit issues, whether that be CRE, office, et cetera. But I think the move we've seen so far has largely just been a recovery bounce.
All right, let's talk about the commercial real estate sector. A lot of talk about billions of dollars in commercial real estate debt that's about to hit the market. How do you see that impacting these regional banks?
Yeah, I mean, look, it's a massive overhang. I mean, we don't know what we don't know in terms of how weak this could become. That being said, we do believe that a lot of the risk is outside of the banking sector today. We think that the dynamics in the market today are drastically different than they were heading into the great financial crisis. One of the numbers we looked at recently, over 60% of the office CRE that's on banks' balance sheet does not mature until 2027 or later. So it's a headwind. It's an issue. There will be losses, no doubt. But it's not this, cliff where everything's going to reprice and re-rate to an 8% yield, this year. It will happen over time, and hopefully we get some relief as we move on.
So a lot of times these stocks, at least in recent weeks, they've been trading on sentiment, and a lot of social media traders on Reddit, Discord, et cetera. They've been actually influencing these stocks along with short selling. In addition to that, how does this hawkish pause or not, how does that impact the actual fundamentals of these banks?
Yeah, I mean, the biggest issue on fundamentals for the banks is just what it does to net interest margins, what it does to NII. So profitability is likely to be slightly weaker in the near term. If we could get a pause, even if it is higher for longer, banks will make more money as asset yields reprice, but we just need time for that to catch up. I mean, that's kind of what we've been saying for a while. We just need more time. But, I don't think there's a drastic difference if we're talking about one or two more hikes, but we do need to reach that pause at a minimum and hopefully get, a couple of cuts in 24 as we get stability. But what the Fed is telling us is that the economy is actually stronger than we had anticipated. So it's not all bad. It just is a near-term headwind, to be sure.